Hello guys, welcome back again. This time, part one, we saw the ratio analysis. Part two, we saw the balance sheet. Now, let's get into the profit and loss statement. So, the profit and loss statement is a very important aspect of any fundamental analysis because a lot of things are derived from the profit and loss statement. And once you have mastered the profit and loss statement, then you can do a very well, uh, I would say, informed decision about any investment in the stock. So now let's see the profit and loss statement of again the same company. We will go. Now there are two parts. If you see this quarters, then this is all quarter by quarter profit and loss statement. We will not get into this because this is only useful when you have to compare quarterly performance of a stock. Once you bought the stock, if you want to monitor how it fared from September to September, like September 24 to September 23, then maybe June 24 to June 23. You must have seen in the newspaper that quarter on quarter the EBITDA increased or quarter on quarter sales dropped, something like that. But we will see the yearly. So this profit and loss, if you click, then this is a yearly. And again, we will see the consolidated figures. Now this TTM means trailing 12 months. So if you are seeing this in September end, maybe October first week, and they have declared this in October end, maybe they have declared the September quarterly results, then this trailing 12 months will be September quarter, June quarter, March quarter, and December quarter. Last four quarters, trailing 12 months. Okay. So we will see now this year on year comparison, what it entails. Uh, Now, first we will go one by one. First is the sales. So, sales is the revenue which we have all seen, and this is all in crores. Okay. It, it is written here in crores. Okay. So this is in crores. This is a big company. Astral is a big company. So it is in crores. So first is the sales. Okay. Now this sales ideally should increase year on year. If the sales is not increasing, then the company cannot generate a good amount of profit. So first condition, we should keep it in mind that sales should be increasing because you can earn profit by reducing your expenses or something like that, but it cannot be on a every year process. So ultimately the sales have to increase. So if you see for this company, the sales every year it is increasing in a very good percentage. And if you have followed me earlier also, this stock is part of the Coffee Can investing portfolio. Okay, because every year it is increasing by at least 10%, barring this COVID time. Okay, other than that, it is increasing more than 10%, and which is a very good sign. So this is sales growth. Now let's come to the expenses. So this is material cost. So whatever revenue is generated, these are the percentage which goes towards the purchase of material. Now this includes raw material, then some changes in inventory. A minus means some inventory has gone to the losses. Then manufacturing cost. Now Australia is into making of pipes and all. So this is the manufacturing cost of machinery. The basically machinery maintenance or machinery production cost. Then there is a employee cost which is very less, 6%, and other cost. So the expenses are reduced from the sales. Okay, so when you reduce these expenses from this sales, it comes as a operating profit. And what is operating profit? We have seen earlier, when you reduce all the items, this is taken as EBIT, earning before interest and taxation. Now there are two types of operating profit. One is EBITDA, one is EBIT. So if you see, this is interest and depreciation. So if you see this, say this latest year, 925 crore, after reducing all the expenses, the margins are 16%. This is operating profit margin. Then other income, this includes this exceptional items and all. Then interest on loans and depreciation of machinery is reduced. Now this becomes PBT, profit before tax. Okay, only interest and depreciation has been reduced. Now tax, generally 25% is a corporate tax, so more or less companies will be declaring this around 25%. There may be some increase because of some other reasons, otherwise 25% is standard across industry. So if you reduce this taxation, this comes to as a 546 crore, and this is net profit, or you can say profit after tax. So this is PAT. Okay, and if there is some exceptional items or maybe some I would say previous year's tax rebate, then it gets added. So if you divide this net profit amount by number of shares available in the market, then you get earning per share. This means Astral is earning 20.33 rupees per share, and it also pays the dividend, and this is a dividend payout ratio. And 18% of the net profit it is earning, it is giving out as a dividend. So this is a how you can go through the profit and loss statement. There are other more items can be added. This we will see it in the Excel sheet formula once we take it out various ratios and parameters out of this original profit and loss table. Okay, uh, so that's it for today. We will jump to the cash flow statement in the next video. Thank you.